Excuse me? Hello. If I could just get your attention. Thank you. Just a brief introduction, and then we'll get on with our presentation. Those who believe that the Thucydides Trap, where rising power challenges the dominance of an established power, say the US and China trade war is inevitable. Professor Lawrence Lau will argue that being the largest and second largest global trading nations means that the US and China are each other's most important partners in several areas. Professor Lau will share economic statistics of the past few decades and show that while the real effects of the US-China trade war are not negligible, they are manageable for both nations. But he will also warn that underlying the trade war is potential economic and technological competition between the two nations that could become the new normal. This should be a particularly interesting topic as trade negotiators convene later this week in Washington to resume very important trade talks. A little bit about Professor Lau. He received his BS degree with great distinction in physics from Stanford University in 1964. And his MA and PhD degrees in economics from the University of California at Berkeley in 1966 and 1969. He joined the faculty of the Department of Economics at Stanford University in 1966. He became the Ko-Ting Lee Professor in Economic Development Emeritus upon his retirement from Stanford University in 2006. From 2004 to 2010, Professor Lau served as Vice Chancellor of the Chinese University of Hong Kong. And with that, please welcome Professor Lau.
Okay. I guess this works. Okay. First of all, thank you, Alexander, for this introduction, and also thank Ander and thank the Foreign Correspondents Club for hosting me today. I have a PowerPoint which I will post on my webpage, so you're welcome to download. In a couple of days, it will be on my webpage after all the typos were removed. Okay, now let me start by saying that you probably all know about this National Bureau of Statistics announcement that last year the Chinese economy grew 6.6%. Okay, now in fact that actually is higher than the target growth rate announced at the beginning of last year, 6.5%. But a lot of people would point to the fact that this is the lowest rate since 1990. Okay. Of course, 1990 and now are actually very different. But I think, nevertheless, I want to show you that that in fact, if you look at the Chinese growth, it's very much like an L-shaped recovery that we talk about, L-shaped decline. It's not a hard landing. Okay, you can see that it's being stabilized, for the last few years at around somewhere between 6.5%. I think what I wanted to explain a little bit why I wrote this book. It was actually quite accidental. I was putting together a collection of my articles published over the years, and the publisher noticed a couple and said, "Why don't you write this book?" And I thought, so it's very topical. So I wrote this book in about 6 weeks, and it came out last December, the English version. Chinese version was just issued a couple of weeks ago. The most important point I want to put across is that it's not the end of the world. The sky is not falling. Okay. Now, the maximum impact on the Chinese economy, as I will show you in a minute, I think is around 1.1%. Now, if you think of an economy that's growing between 6 and 6.5%, okay, if you slow down by 1.1%, oh, it's okay. It's quite tolerable. And the impact on the U.S. would be even smaller. Okay, impact on the U.S. is actually about less than 0.2%, which is almost nothing. I think somebody said this in the rounding error, some truth to it. Okay, now, but the first impacts on the is mostly psychological. The trade war basically, these news of a trade war were unfamiliar, it started last year around the end of January that we knew it was coming. If you know this chart, I don't have a pointer, but the green line up above is S&P. The S&P actually did not decline at all until the end of the year. Okay, 2018 is about even for the Standard & Poor index. But the bottom line, the yellow, was Shenzhen. Shenzhen actually lost about 30%, the stock index, all right? And then all the ones in the middle, the next to the bottom one is Shanghai, and then you have the MSCI, and then the two that is upper correspond to Hong Kong and the Chinese enterprise in Hong Kong. But you can see that the impact actually is really quite fast on the stock market. But I want to say that the Chinese stock market is not a very good barometer of the Chinese economy, as many of you know. The average holding period, well, we all know that the Chinese stock market is dominated by individual retail investors, and the average holding period is less than 20 days. All right, so hard to say that they are long-term investors. So at the first sign of trouble, they'll bail out, and they will stay on the sidelines until things look clear. They are not clear yet. Okay, so they are not coming back in. So I think that we shouldn't be too worried about the stock market per se. Okay, and you go back and look, it's not a very good reflection of the economy. Now, what I'm now showing you is the exchange rate. The red line is actually the central parity rate. Okay, this is the rate at which the renminbi starts trading every day. The blue line is actually something that if you have not been watching, you should start watching. Okay, that is called the CFETS, the Chinese Foreign Exchange Trade System Index. It is actually a trade-weighted, Chinese trade-weighted basket of currencies, of the exchange rate. So you can see that even though, if you look at the red line from the end of January to now, perhaps the renminbi has actually devalued 8–9% or thereabouts, right? But if you look at the difference between the blue line and the red line, it's only within 3%. Okay, and I think the key is that if you think about it, there's really no particularly strong reason for the renminbi to follow the U.S. dollar. After all, the U.S. is only slightly more than 20% of Chinese trade. All right. So if you actually follow the U.S. dollar, in the first place, the U.S. may not be pleased. But if you actually follow the U.S. dollar slavishly, that really means that when the U.S. dollar goes up, you raise prices to the other 80% of your customers, which makes very little sense, right? And if you the other way around is the same. So I think you ought to basically start looking at the CFETS, which is really a basket of with trade-weighted currencies. Now, I also want to say that China actually is a very large continental economy with a huge domestic market, which we all know. But what is the implication of that? Implication is that China is not very vulnerable to fluctuations, to outside fluctuation. Let me show you a couple charts. Now, this is the quarterly rates of growth of exports of goods of selected Asian economies. You can see the Chinese line is a red line, never mind over the others. They are all different Asian economies. But what you can see is that Chinese trade fluctuate like everybody else. Chinese exports like everyone else. Okay, and then this is the import story, and you can see again the red line fluctuates like everybody else. Everyone fluctuates up and down together. So that is basically what's happening now. This is actually the interesting chart you should look at. The red line is China. It shows the GDP growth rate. The GDP growth rate of China fluctuates, but it doesn't fluctuate like anybody else. Okay, everybody else has very, very dependent on what happened on the outside, and the Chinese GDP growth rate actually is really quite stable. Okay, you can see the red line. It's relatively immune to whatever happens to outside. Now, the same is also true of the U.S. the U.S. economy is basically completely, almost completely independent. Whatever happens on the outside can affect it. It's mostly internal demand driven. Now, the next thing I want to show you is the following, which is interesting. This is the Chinese exports of goods and services to the world as a percent of Chinese GDP. The red line is goods and services. The blue line is goods only. Why do I just show you goods only also? Because tariffs are only levied on goods, not on services. Okay. So it's the goods that would give you a good idea of what's actually going on. Now, this is actually probably one you should pay most attention, is the following, is that Chinese exports of goods and services, as well as the goods alone, to the U.S. as a percent of GDP. You can see that actually it was quite high. It was at 1.7% of Chinese GDP, but now 2017 it's gone down to 3.4%. Now, that actually, 3.4% is interesting because that should give you some idea what is the maximum damage that the trade war can possibly do to China, right? I mean, the worst thing is 3.4% of GDP. Even if all exports disappear, it is 3.4%. But in fact, the tariffs today, we don't know what happened later, but at least today, the tariffs were only on half of Chinese exports to the U.S. So it's about 1.7% of Chinese GDP, right, at various rates. And the other thing that we should remember, though, is the following, is that the value added of Chinese exports of goods to the U.S. is also very low. Okay. Now, to give you an example, a very low value-added export would be the Apple iPhone. The Apple iPhone sells for about $600, but the value added in China, the GDP created through the manufacturing of the Apple iPhone, is less than $20. Okay, and so you should remember that is only of a value added as a percent of export. It would be about 3-4%. Okay, it's very, very low. And now that's not true of all Chinese exports, but on average, Chinese exports would be around 25% value added. Okay, and so if you multiply 25% to we call 1.7% GDP, you get a number of 0.43%. I don't want to bore you with the numbers, but basically it is a relatively small effect on the Chinese economy. Negative, never, yes, but actually not that huge. Now, I want to add one thing while I'm on this topic, and that is the direct effect was 2.5% of Chinese GDP, but there are also indirect effects, what I call second, third, fourth round effects. Basically, that has to do with the reduction of once you reduce exports, you will reduce domestic production. But a reduction in domestic production, in turn, will lead to further reductions of domestic production because they use domestic inputs. So if you actually do that calculation, the final number is 66%. That is basically for every dollar of Chinese exports to the U.S. that's lost, the loss in GDP ultimately in China would be $1 would be 66 cents. Okay, so that's roughly the idea. Okay, now what I wanted to show you to say is really it's completely tolerable that these magnitudes is not going to lead to a collapse of the Chinese economy, but it will actually have impact on basically on importers in the U.S. shifting their orders to Vietnam, to various places to avoid the tariff, which is really quite natural. And in fact, there are many Hong Kong investors, manufacturers, Chinese manufacturers who already have operations in Vietnam, Cambodia, and Bangladesh. Okay, and now they are actually going to Ethiopia, because they are seeing this coming, and this chart that I have on the screen is actually quite interesting. The red line, the red columns, the red part is basically China's share of U.S. apparel imports. Okay, now the blue part at the bottom which is declining over time to almost nothing, is the combined share of Hong Kong, Taiwan, and South Korea. Okay, you can see that it happens. It happens, and I think that as Chinese wage rates go up, exchange rates appreciate, it will migrate. Okay, and the tariff will actually accelerate the migration. Okay, it's already happening, right? And it will just make it faster. And there's no holding back. That's progress. As your wage rates go up, you start to make other things. You don't make apparel anymore, and that is to be expected. But this would be accelerated. Now, what I talk about is the effect on China in the aggregate. All right, but in regions it would be a little bit more serious. But take Guangdong, the province of Guangdong, for example, exports to the U.S. as a percent of Guangdong GDP is about 8.7%. Okay, so it will actually have a slightly larger impact, but so far it hasn't really been showing up in the data. In the Guangdong GDP growth this year, first 3 quarters of last year is still 6.9%. Okay, which is quite reasonable. Okay, so anyway, maybe this year it would be worse, but it would happen. Now, this is, some of you may be interested, what happens to Hong Kong? This is the chart for Hong Kong, and if you look at the green line is actually important. The green line would be exports of Hong Kong goods to the U.S., Hong Kong manufactured goods. You can see that it's really gone down to zero. It was quite high in the 80s, okay, but it's gone down to zero. And the blue line is the re-exports, and the purple line is also re-exports from China. That is almost all the goods export from Hong Kong consist of re-exports from China. Okay, so if you think about what is the direct impact of Hong Kong of the tariffs, the answer is very little, because the value added of Hong Kong value added on re-exports of Chinese exports is very low. Okay, and Hong Kong is not really exporting anything, any manufactured products anymore. Okay, now what about the impact on the U.S. economy? The U.S., as I said, is even larger economy and is even less dependent on exports. Exports of goods and services as a percent of U.S. GDP is around 12%. Okay, very, very low. And this is U.S. exports to China. And you can see that the exports of goods, see, it's only goods that are subject to tariffs, okay? Goods as a percent of U.S. GDP is actually 0.67%, okay? It's almost nothing. Now, the U.S. value added content is bigger. Okay, it's about 50%. Okay, and if you actually do the calculation to look at the impact of the reduction in exports from the U.S., the total goes up to 88%. Now, the way to think about it is the following: if the U.S. exports beef, the cows eat American grass, so the value added is higher. Okay, unlike the iPhone, all the parts from all over the world. Okay, so anyway, all right. So, but even if at that 88%, it is still very low. Okay, and because the total export is only 0.67. If you have, so the impact on the U.S. is actually going to be quite small, and I think there are actually U.S. exports to China that cannot be, that are indispensable. For example, computer chips, for example. So it's not going to go to zero. So the U.S. can easily weather the trade war without too much problem. The only thing that might affect would be service trade, because the U.S. has a very substantial surplus in service trade, somewhere between 40 and 54 billion US dollars, which is quite significant. Okay, now I need to go fast because I'm running a little bit out of time. I want to basically, in my book, which are you interested, basically I analyzed the the real trade deficit between U.S. and China. You know, the usually quoted number is 376 billion. Okay, this is the official U.S. number, but it is really the U.S. estimate of the trade deficit just without looking at services. Okay, now, but that actually suffers from several defects, which we don't have time to go into. But basically, that includes only the re-exports of Chinese from Hong Kong as part of the U.S. import, but it does not include re-exports of U.S. products, U.S. goods through Hong Kong into China. Okay, so which doesn't make too much sense. But if you do all the calculations right, and then you get a number of around 254 billion, which is still a large number. But if you now go on and try to do the calculation that I just tried to make, namely to look at value added rather than look at the gross value, actually the trade deficit actually comes down to 111 billion. Still a large number. I wouldn't call anything exceeding 100 billion a small number, but it is really within the realm of possibility of closing that gap. Okay, or in a couple of years. It's not something that's not possible. Longer term, I would say that the underlying this trade war is really a long-term competition for economic and technological dominance. Okay, and this is not going to go away. All right, so in some sense, you can think of this as the new normal. Chinese GDP was only 1/5 of U.S. GDP in 2000. 1/5. To 2017, Chinese GDP was 2/3 of U.S. GDP. All right, you can see that at this rate, you know, Chinese GDP in the aggregate, okay, is going to come up to the U.S. level. I have some projections. Certainly by the early 2030s, it would be neck and neck with U.S. GDP. Now, per capita is another matter. My projections show that Chinese GDP per capita will not catch up to U.S. GDP per capita until the very end of the century. Okay, right now it's more than 6 to 1. U.S. per capita GDP is 60,000. Chinese GDP per capita is about 9,000, compared to 60,000. So it'll be a long time. Okay, all right, all right. Now let me actually raise a hand, and I need to talk about this. Talk about some U.S. I'll steal a few minutes from the Q&A. Right? One of the things is that intellectual property protection. I mean, those are the major U.S. grievances. I think the Chinese protection of intellectual property rights has actually improved quite a bit since 2014. They set up special courts for it, and they are now actually imposing serious fines. Okay, in the last few cases, people were fined 1.5 million U.S. dollars, which is enough to deter a lot of people. So I think so I think it's actually going to not be an issue because I think there are now a lot of Chinese inventors and discoverers who want their rights to be enforced. So there would be substantial constituency for enforcing IP. And if you really think about it, this really follows the same pattern as Japan and Taiwan, right? You know, and we know that Taiwan used to be the book of pirated books capital of the world, but there's nothing there now. It's very strict enforcement. So I think that's going to come. The other grievance has to do with forced technology transfer, but I think that is also going to be moot because we know that Chinese laws have changed. You know, Tesla has a wholly owned subsidiary in Shanghai, and BMW was able to buy 75% of its joint venture in China. GM didn't want to buy out their local partner, right? So basically, once you can control your own, you know, you don't need to. I mean, the forced technology transfer basically means that you have to share your technology with your joint venture partner in China. So I think that's going to disappear. I think cyber theft is something that I think both countries, both governments should work together. No matter who's doing to whom, theft is theft. Right? I mean, theft is criminal. All right, no question about it. And whether it is Chinese firms stealing from Chinese firms stealing from U.S. firms, U.S. firms stealing from China, it's theft is theft. I think that is something that that's the only way to solve the problem. So I think the one thing to think about is that the technological competition is not necessarily bad. Let me give you an example. Last year, the fastest supercomputer in the world was IBM Summit. Okay. 2016, 2017, the fastest supercomputer in the world was the Sunway Taihu Lite, a Chinese computer, for 2 years in a row. Right? But now, 2018 is, so the competition in some sense is not bad because it actually force both countries to improve, and I think that's a lot of it could happen. Now let me fast forward to give you some idea of the projections. This is a projected growth rate. You can see that the Chinese line is going to cross somewhere in the early 2030s. And that's really a result. The columns are the growth rates. The growth rates are higher, but per capita, you can see per capita still a huge gap. Okay, even at 2035. Okay, now on technology, I think China is still actually quite behind on average level, and there's a good reason for it. It hasn't been spending enough on R&D, investing enough R&D, hasn't been spending enough on basic R&D. This is the number of patents granted by the U.S. The red line is China. It's coming up very fast, but it's still quite a ways from the U.S. and Japan. And this actually shows you, this is a very interesting chart, it shows you that it is investment in R&D capital that really would allow you to have more patents. The patents have a direct correlation to R&D capital. But this is actually also an interesting chart. China is investing far too little in basic research. See, the U.S. invests about 18% of R&D in basic research. Japan is around 14, the yellow line. China is actually below 6%. Now, you cannot make breakthrough discoveries or inventions without really spending money on basic research. You can make marginal improvements, but basic breakthroughs you really need to invest in. Now, finally, I want to say that I suggested that the easy way to close the trade gap would be for the U.S. to produce new production, to produce new output to sell to China. Okay, and there are many things that can be done: liquefied natural gas from Alaska, shale oil, agricultural products, beef, meat, chicken, and so forth. So, and I think the Chinese demand for all these things are growing very fast. And so it would be win-win for both sides, okay? Because U.S. has new production, new GDP, China gets what it wants, and both sides should be happy. Okay, now let me conclude by mentioning Graham Allison. Some of you may have heard about him. He has actually been going along saying that quoting the Thucydides Trap, namely that when a rising power and a existing power, that they will always come to blows eventually. I think that's not necessarily the case, but we don't have time to talk about him. But I think the way to prevent it is really for both China and U.S. to increase their mutual economic interdependence. Okay, and much like Germany and France, okay, that in Europe, so to make really a war which would be devastating for everybody, really unthinkable, is to increase the mutual interdependence, and through that you can actually do mutual trust. So let me actually stop here. I'm sorry I exceeded my time a little bit, but okay, thank you.
Thank you, Professor Lau, for a very interesting talk. So we'll turn to the question and answer period of the talk. So if you have a question, please prepare it. I'll kick off with one for you, Professor Lau. Sure. Overnight, the Trump administration filed charges against Huawei for violating sanctions, U.S. sanctions on Iran, and for stealing stealing trade secrets. How does this, if at all, change the calculus or the outcome for the trade negotiations and the trade war?
I think that's a good question. The first thing I want to say is that these are charges, and whoever is accused should be presumed innocent until proven guilty. Okay, so we need to see the evidence and so forth. So we await the courts to decide. But I think the case itself, Huawei case, and the trade talks, I think they actually have been proceeding in parallel. I'm not even sure they are linked, okay, because it's well known, even for since December 1st, right, that there is this Huawei case. So it's nothing new. So I actually don't think it will actually disrupt the negotiations. Now, whether at the end it will have some impact, I don't know. Okay, but that would be up to the presidents to decide, right? But I think so far as I can tell, I think they would be proceeding in parallel. Okay.
Thank you. So please go ahead.
Thanks, Professor Lau. You touched on some of the key issues in intellectual property, technology transfer. The other kind of deeper issue is around the U.S. complaints on the state kind of role in China and how it promotes certain industry, China 2025, all those elements. What's your view on how the trade war changes that, if at all, from the Chinese point of view?
Well, I think it is really very hard to tell somebody else how to organize their household, right? And the U.S. doesn't have many state-owned firms, but Europe has many European countries have state-owned firms. All right, so I actually would say this, though: if I were a U.S. firm, I'd much rather compete with a state-owned enterprise. Okay, much easier to compete to a state-owned enterprise. All right, so I think that is something that eventually people have to accept. So my suggestion is that we should focus on behavior. Focus on behavior of firms. Don't focus on the ownership. Right? If the firm is monopolistic, even though it's private, right, the regulator should go after it. All right, but if it's state-owned, but it's behaving properly, I personally don't see any particular problem. Right. So that would be my view: is really focus not on ownership, but on behavior. All right. And if it's engaged in unlawful behavior, go after it. Okay. I have very little sympathy for Zhongxin, for example, for ZTE, right? But anyway, I think that would be my answer to you. Now, Made in China 2025, I think actually the big mistake, if you can call it a mistake in China, is to publicize it too much, right? Okay, I mean, it's quite reasonable for all governments to fund basic research, right? How do you think we got the internet now? Because ARPA, Advanced, or DARPA, later DARPA, Defense Advanced Research Project Agency. Well, I mean, they fund it. All right, so I used it. I was in the U.S. I used the ARPANET in the 60s and 70s, right? But basic research has to be funded by the government because there's no return, no financial return. No one would fund it, with some exceptions. I think Bell Labs, AT&T, when it was a monopoly, it funded Bell Labs, which is great for the rest of the world, right? But once AT&T was broken up, Bell Labs disappeared, right? And some of you may have heard of Xerox PARC, Xerox Palo Alto Research Center, where all the major, computer-related things were invented, Ethernet and so forth, the mouse. That was because Xerox was a monopoly. It could afford to do it. No, I mean, Xerox PARC is no more. So what I'm trying to say is that the government funding basic research, I don't see anything wrong. Okay, I mean, even the U.S. at one time, we had Sematech. Right? Sematech was a consortium of semiconductor companies, and the government put up $500 million to make it happen. Right? It's a consortium. So I think there's really not really a problem, and I think that that where you really draw the line is really on behavior, and I think quite properly, if there were subsidies of companies, I mean, they ought to come out. Right. I mean, I think the key is really to regulate what kind of behavior is acceptable and not acceptable. I hope that answers your question.
Thank you. Okay. Anyone else? Yes, please.
Please.
Mr. Lau, you mentioned, right, you demonstrated that on an aggregate basis, the trade war is not a big worry. Not a big worry for China.
Right.
And you briefly also said regional. There are differences.
Right.
Now, how vulnerable is China in terms of this regional? I'm thinking of the economic regions,
right,
where a lot of the production and so on is concentrated. And doesn't China have to worry about unrest if all these people are laid off and so on? There's a political element.
Yeah.
And if I want to damage China politically, I would concentrate on these regions.
Right. No, that's a good question. But as I mentioned, Guangdong, the Guangdong province, the province right north of us, is the largest exporting province in China. It has the largest exports. And Guangdong's export of goods to the U.S. is 8.7%. Okay, it's not overwhelming. It's only 8.7%. And if you actually do the calculation, that the value added and so forth, it would actually come out to do damage maybe less than 3%. Right? But Guangdong's growth in 2017 was around 10%. All right, so you go down from 10 to 7, maybe to 6 even. It's okay. Right. Now, the thing is that we shouldn't really be too fixated on the growth rate for the following reason. Today, 5% growth rate today, in terms of absolute amount, is equivalent to 10% growth 10 years ago, because the base is so much bigger. So it's not a. But I take your point. I think Guangdong will suffer more than the rest of the country, and probably within Guangdong, Shenzhen will suffer more than the rest of Guangdong. Okay, because it's not. But even Shenzhen, the share of exports has come down. You know, at one time, Shenzhen's exports is 250% of Shenzhen GDP. 250%. Okay, now it's actually come down, I think something more reasonable, like 60–70%, but to the US it's maybe around 11%. Okay, so Shenzhen would be would be more vulnerable, but I think it would Shenzhen is doing fine.
Okay, if we could do one more question, please go ahead.
Did the U.S. have to do something about the trade war? About the trade deficit?
No. I mean, I think most mainstream economists would say no. All right, because most mainstream economists would say that the trade deficit is a result of a domestic savings investment imbalance. You're absolutely right. Okay, now, but you know, people are fixated on it, right? And you can't tell them, don't worry, it's not a problem, because if they really think it's a problem. But what I have suggested is something that really is win-win. Because I'm not suggesting that the U.S. should ship to China what is now shipping to Japan, right? Because that wouldn't do anything, okay? It would just be cosmetic. Chinese trade surplus shrinks, Japanese trade surplus expands, right? It doesn't really do anything. So what I am proposing in my book is really that we should focus on new production. That is, the U.S. should produce things that hasn't been producing and export these things to China, and China will have the demand for it. And what are these things? Liquefied natural gas from Alaska, which hasn't been exploited yet, new shale oil, and instead of shipping soybeans and corn to China, the U.S. can ship beef, pork and chicken to China. I mean, why go through the trouble of shipping corn to China to feed the cows there, right? Why not just ship them the beef? Right, and I think this is actually win-win, because in China is short of land, short of water, right? So it's much better for the U.S. to raise the cattle here, more cowboys here in the U.S., and then to ship the meat to China. I think that would be good. Now, I should add that in order for this to happen, what is needed is a long-term agreement. That is, no one in Alaska is going to invest in liquefaction of natural gas unless it's going to be at least a 10 to 20-year deal, right? And the same is on the Chinese side. They have to build terminals to receive and unless it's long-term, nobody's going to do it. So in some sense, what I'm proposing is actually really generating new GDP, new employment in the U.S., and to provide for new supply to China. And China would be able to use this because its demand is rising, so it would not hurt the current domestic suppliers.
Thank you.
Can I answer that directly to this suggestion?
Sure.
What you basically suggest is that America, in the longer term, we go back to the third world stage. They export raw material, agro products. It will be a situation like France and Germany. Germany produced the added value, high-end products, in France the agro products.
No, this is called a Liangtear Paradox, if you know Liangtear. But anyhow, China would be perfectly happy to buy high technology products, but the U.S. is the one that refuses to sell high technology products. It's not that there's no demand, there's really no supply. And I'm just trying to propose things that there will be both supply and demand. All right?
Sorry, we've got one more question over here. Just hold on one second. Just wait for the microphone.
As an economist working on China, what do you think of the reliability of Chinese figures?
Very good question. I got asked that almost all the time. But I would say that I first declare that I'm an advisor, international advisor to the National Bureau of Statistics of China. Okay. All right. Now, but I would say that there's really no evidence of the central government, the National Bureau of Statistics, tampering the data. Really no evidence in the last 20 years. Now, there's really one interesting thing that you can find out yourself. If you go and look at the Chinese statistical yearbook, the growth rates of every province and region are published. Okay. Now, if you now do a weighted average of all the provincial rates of growth, you should get the same as the national rate of growth, right? Okay, but you don't get it. You get something for the last 20 plus years that is sometimes 2% higher. Okay, that basically tells you that the central government does not really rely on the provincial statistics. Okay, now, so I think it's really quite. The statistic actually is really quite credible myself. I mean, the central government statistics. Now, I don't want to give the impression that the provincial authorities are making up the numbers. Okay, but I just want to say that provincial figures are very hard to get, and it's the same reason that you cannot get California GDP. California GDP is also very hard to get because you can get consumption, you can get investment, you can get government expenditure, but X minus M, which is export minus imports, there are no customs. You know, from California, you export to Oregon, you export to Nevada, you air freight something in New York, or whatever you buy, you don't know. So California GDP is just as hard to calculate as Guangdong GDP, right? So, so I'm not blaming the provincial authorities. I'm just saying that it's intrinsically hard, but I don't think there's any evidence for the last 20 plus years that there's been any tampering of the data.
Thank you. Kick it off with one last question from Enda.
Thank you, Alex. Professor, if I could ask, back on the trade war, away from the goods deficit, what kind of concessions should China make to solve the structural concerns that the U.S. has?
I don't actually know what you mean by structural concerns, but I think China is opening very fast, and I think they are getting rid of the, for example, I just mentioned, you don't need a local joint venture partner anymore. You can be wholly owned, and there's now a much shorter negative list instead of positive list saying where you can invest. There's a negative list saying where you cannot invest, and I think that the next step probably would be national treatment on a reciprocal basis, right? I think that's reasonable. You know, you shouldn't treat them better than your own corporations, but you shouldn't treat them any worse, right? So I think those probably would go a long way to answering these grievances. I think it's sort of hard to, someone actually asked me whether all these privileges granted would be extended to all other countries. I said yes, they would be extended to all countries. That if it, you know, I mean, even today, I mean, if there's a reduction in tariffs, to the U.S., it would apply to all other countries. That's the only way that would happen.
Thank you so much for your presentation and for your time. Professor Lau's book is available at the front, both in Chinese and English, and he will be signing copies. So if you're interested, please take the opportunity. Thank you.
Thank you.
Thank you so much.